Hello, everybody. Welcome. You know, it's so much nicer doing these events in March rather than January. You know, you don't have to worry about the snow and ice and whatever. It's just so much nicer. Now, the downside is we've invited you at a time in our world that is a little different. It wouldn't have been like this in January. So there's pros and cons, but after today, hopefully you'll make sense of it all. But I can't thank you enough for taking time out of your day to join us. Marty, it doesn't look that bad. Marty's been worried, sick, for 2 days that we weren't going to have enough people. Look at Marty. I
wanted everybody to have a seat.
But it looks like everybody's comfortable, Marty. But no, really, in all seriousness, it's always great to see you. And just, you know, every year it gets bigger. We've had between yesterday's lunch, last night's dinner, and tonight we've had almost 400 clients come and hear what we have to say. And as I say to my team all the time, I mean, that's a beautiful thing when they trust us. One, you put your full faith and trust in us to manage your wealth, and we don't take that lightly. We take it very seriously, and all we really care about is making sure we meet your expectations, whatever those expectations are, and if they're unrealistic, we'll let you know that. But really, all seriousness, all we really care about is making sure we do everything that you think we should be doing for you, everything that you wanted us to do for you. And I know, you know, the stories of you know, the clients that come up and say, you know, I have more money now and I've been taking it out for years than I had before I came with you. And, you know, I can go on and on and on about the stories. We have one client who was brilliant, set up a trust fund for his grandchildren, all of his grandchildren, and he's been passed for years now. Any grandchildren that wanted to go to college, the trust would pay for it. And then when the youngest grandchild turned a certain age, the money gets turned over to charity. To know that money is worth so much more now with all the grandkids going to college. I mean, these are the stories we love to hear, but we take our job very seriously, as you know. Being a fiduciary, so we've been in business for 36 years. We've been a fiduciary for 33 years, back before anybody knew what being a fiduciary was. And, you know, back then, you know, listen, I was making 6% commission selling annuities and mutual funds, and I loved helping my clients. I just didn't like how I got paid. So in 1993, I developed a relationship, a partnership with Charles Schwab, and we've been a fiduciary ever since. And we could be with Vanguard or Fidelity or anybody. Back then, Charles Schwab was the biggest, the best. They still are the biggest and the best, so we have had no need, and we don't get anything back from Charles Schwab. We had no need to really change that relationship, and we've been a fiduciary for a long time. Now it's a buzzword. You hear a lot of people throw it around, but we've been doing it for a long time on behalf of our clients, and that means that all we care about is really what's right for you. We call it like it is. We don't hold anything back, as you know. I tell this story often. A few years ago in the thick of COVID, when the stock market went down 34% in a few short weeks, I had that one client that called me, and he said, Steve, he said, you know, I can't lose any more money. And I said, oh, I didn't know you lost any money. Oh, no, the market's down. You know, look at my statement. I said, yeah, but you haven't lost any money. It's just on paper, right? No, let's sell. When the market goes back up and makes new all-time highs, let's get back in. And I said, I paused. I said, does that even make sense to you? If I could have gone through the phone line, I would have been shaking him left and right. And he thought about it. He said, no. He said, I guess that's why we engaged you. I said, you sure did, because we take the emotion out of the decision-making process, and we truly do take the emotion out of the decision-making process. And tonight, you've come at a good time with everything going on in the world. I think the information you see tonight, not only is it going to be timely, but for those of you that may be nervous, believe it or not, a lot of people say, boy, the phone must be ringing off the hook. You know, a couple weeks ago, I was up 3, 4 o'clock in the morning, and I started preparing a white paper, and before all my colleagues came into work and got to their desk, they had a whole, you know, a whole white paper on what to expect, how to help educate clients if they do call, and we were prepared for it. And as it turns out, over the last, a couple of weeks. The markets, the headlines have been brutal. War is never nice. The headlines have been brutal. And the stock market, though, trades on fundamentals. And I think the presentation you're going to see tonight from everybody up here on the stage with me, I think you're going to leave here realizing that, sure, there's geopolitical risk. The market goes up and down. But as Steve always says, the market always comes back. It always goes back to make new all-time highs. That's a beautiful thing. And if you keep that in mind, you remember that, you don't get nervous. Before we get into it, I just want to say, a lot of you have reached out to me, and I just want to say on a personal note, I'm in a good spot. Mentally and physically, I'm feeling good. Our firm has had a rough couple years. It's been almost 2 years, April 1st, where, I was in New York City for some treatments, and we lost Sue in May, and we lost our beloved colleague Nicole a year ago, January. So the firm has really gone through a rough couple years, and we're just getting back on track. We've gone through the first of the first, all the holidays and anniversaries, and we still stay in contact with Nicole's husband and invite him to, events that we have internally. And we're really, we're doing good, and I'm doing good, and I thank you all for reaching out to me. I can't begin to tell you how much that means to me. Tonight I got one of Sue's classmates, Cherry, who's here, and when I see her, one of the last people Sue saw was Cherry at a high school reunion, and our close neighbors are here, Terry and Kathleen, and, it just, before I came here tonight, Lauren and I went to the cemetery, and, it's just, when I stand before you and I thank you for being here, you're part of my family. My colleagues that I work with are definitely my family, but I can't thank you enough for just all the care, all the attention you've given me, and just reaching out. I can't begin to thank you enough for that. Later on, before we close out the show, I'll go over a few more things, but thank you for all your care and your prayers, and just for mostly putting your trust and faith in us. So let's get started with the show. We have a lot to go over, and there it is. So a message from our founder, that's me. 36 years, can you believe that? I've been helping clients for 40. It's a long time. But I'm doing good. Warren Buffett was 94 before he retired. Sometimes some of my friends up here say, hey, don't you want to relax more? I said, I'm relaxing. I said, I'm relaxing more than I've ever relaxed, because I'm surrounded by good people, and my leadership team is rock solid, and they're doing all the heavy lifting. It just allows me to kind of really do what I enjoy, and that's being with you and keep an eye on the investments and all of that good stuff. But I am surrounded by some good people, and tonight you're going to hear from 5. We have 22 professionals now, and all 22 are dynamic. Tonight you're going to hear from 5 of them. So a message from me, that's over with. State of the firm, John Millay. Then we have our economic outlook, Marty Shields. Portfolio positioning, Paolo LaPietra. Artificial intelligence, and believe me, you hear me talk a lot about this on the radio, and if you're not using AI, you really gotta just branch out and start playing with it. It's not like AOL where it's gonna disappear. I really think AI is here to stay, and it's gonna be here for a long time, and it's amazing. I had a meeting with, every month we go out as a team, all of us, all 22 of us, for dinner. In a couple months, I wanted to bring everybody together because there was so much in the paper about AI replacing jobs and this and that. And we want to embrace AI, but not to replace anybody. We want to embrace AI to be able to do a better job, all that it brings. And I met with all of our team, and I told them, I said, AI will not replace one job. If anything, it's going to create more. And we're able to do that much more. But AI is here to stay, and Ryan is going to go into that in detail. And then we have Harmony Wagner with some advanced planning. And I'm telling you, when you get done with all of this, and we're going to have questions and answers, I think you're going to leave here saying, I'm glad we came. And let's get started with John Millay for the state of the firm, and I'll see you in a few minutes.
Thank you, Steve. As Steve mentioned, my colleagues are going to be presenting about the economy, the markets, AI, some financial planning topics. But before we get into that part of the presentation, we want to take a few moments to talk about something we feel is just as important, and that's the strength and future of our firm. You know, Steve, as you mentioned, founded the firm 36 years ago, built it on the foundation of trust, integrity, commitment, and really doing what is in our clients' best interest. And 36 years later, those are still our guiding principles. They guide every decision we make. And Steve mentioned our 22 colleagues. Every one of those colleagues embodies our core values. And over those 36 years, we've built an incredible team, a team with advanced designations in tax planning, investment management, financial planning. And we think that's important for you as our clients. Because as a client, you are surrounded by our 22 colleagues. You may work primarily with one or two advisors, but you are surrounded by the entire team. So if an advisor needs to bring in somebody with equity compensation expertise or tax planning expertise, they do that. All of our team is there for you, and we're committed. We're committed to also continue to grow our capabilities. Your lives have gotten more complex, so we've needed to expand our capabilities to meet that demand. More enhanced tax planning, more investment strategies, some of which you'll hear about from Harmony tonight. And we're committed to keep investing in both our people and our capabilities. And most importantly, our leadership is stronger than ever. Steve has been a dynamic leader for 36 years, but he also put in a leadership team of myself, his son Ryan Boucher, and Marty Shields as part of his succession plan. But I will say in our firm—
I'm not going anywhere.
He's not.
I'm not
He is not. But we are planners, so we do plan. But what's important to know is leadership is not just a word at our firm. It's not a title. It's a quality, and it's a quality that's ingrained in every one of our 22 colleagues. And I could sit here and give you example after example of how our colleagues show leadership. I just want to mention a few. I want to highlight a few. Angela Cesny, who's been our Director of Client Service for decades, been with Steve for 27 years. Angela is not retiring, I want to make that clear, but she is slowing down to a 4-day work week. And what that has allowed us to do is elevate Jamie Durkee as co-director of client services. And what a gift Angela's given us. She's able to sit by Jamie's side, mentor, coach her, and develop her. And we appreciate that so much. I also want to highlight two of the colleagues who you're going to be hearing from tonight. Harmony Wagner was recently elevated to our Director of Financial Planning, and Paolo LaPietra was elevated to our Director of Portfolio Strategy. So I want to end with, we are incredibly grateful for all the trust that you have put in our firm, and we will never take that for granted. We are committed to continue to build our team and our organization to guide you for years and generations to come. So thank you. Before handing the mic over to Marty, I just wanted to go through some Q&A format. So this year, we're changing up our format a little bit. We did get some feedback that 120 slides in 45 minutes is a little bit too much. So what we've done is everyone's going to present for around 5 minutes and go through 4 to 5 slides, but then we've got an expanded Q&A section. And on your table, we have a high-tech way of doing that. Using a QR code, we use a program called Slido, and you can enter questions in there. That's going to go to my iPhone, so if you see me looking at my iPhone, it's not because I'm being rude, it's because I'm looking at the questions. And I would say if anybody has problems with their Slido, raise their hand, and one of my colleagues will come over to help. So I want to thank you for being here tonight, and I'm going to turn the presentation over to Marty.
Thank you, John. As always, it's great to be here to present to you. And today I'm going to be talking about the economy and what we're seeing. When we look at the economic data for 2025 and the first quarter of 2026, we see a lot of strength, a lot of resilience. A lot of the data shows that things continue to grow. We have GDP growing at around 2.5%. We have unemployment in the low 4% range. We have inflation trending to the 2% target. We have corporate profits that continue to increase, along with corporate profit margins. We have consumer spending that continues to increase. And as we move into 2026, we have the one big, beautiful bill that's going to provide a lot in tax refunds that it will almost increase GDP by 1%. But under these headlines, there's some cross currents that show some divergence in some of the data groups. You hear this, this notion of a K economy. And what that means is you have some elements of the data that really show strength, but other areas that show weakness. And one of the areas that stands out is in consumer spending. So as I mentioned, consumer spending is doing very well this year and last year. It continues to increase. But it's not across all sectors. What you're seeing is the higher income earners that are spending more, right? That's really what's driving consumer spending. The lower income earners are struggling a little bit. And where, to me, kind of highlights this is Delta Airlines came out. Their CEO talked about earnings for 2026. They're going to see 10% increase in revenue for 2026. But it's the premium seating where all that growth is going to be. Because in the coach seating, it's actually declining for this year. And you're seeing this across industry and from companies. So what's causing this issue? Okay. So let's talk first about income, right? So this basically shows wage growth for higher income earners, which is the blue line, and for middle and lower income earners, which is the red and yellow line. So as you can see, back a few years ago, the red and yellow area, those lines, those income earners were seeing good wage growth, but that's switched, right? In the last year or so, now it's the high income earners that are seeing that wage growth, and lower and mid income earners are not seeing the same thing, and that's starting to materialize into spending. But that's not the whole picture. The other element that exists is on their net worth statements, right? The assets they have. So those high income earners, they usually own their own home. They might own 2 or 3 homes. So that has appreciated dramatically in the last 5 years. And oh, by the way, the mortgages with those homes, they've refinanced into much lower mortgages, and they're actually paying less. So think about that. The value of their home has gone up, but what they're paying for that home has actually gone down. Now, on the flip side of that, those lower income earners, they're probably renting. And over the last 5 years, rents have increased dramatically, right? So that's really a burden on these lower income earners. Same thing with the stock market, right? Many of those lower income earners, they don't have stocks, but most high income earners, they do have stocks, and the stock market's done very well the last 5 years. So that change in net worth, in wealth, is really driving a lot of this consumption. And then we moved into the spending or the cost element. So in many areas, even though inflation is moving to the 2% target, it's still out there, right? It's still in the mid to high 2s. It just came out at about 2.4% for February, but it's still not at 2%. So things like food and utilities, daycare services, all these areas where, especially when it comes to fixed cost, if you're in the lower income bracket, it's really impacting you. This slide I have shows healthcare premiums. So over the last 25 years, it's gone up 5-fold for a family of 4, right? So somewhere in the neighborhood of $6,000 back in 1999 for healthcare premiums, now it's almost $27,000. So again, this impacts all of us, but if you're in the lower income brackets, it really causes a lot of stress and limits how you're going to be spending your dollars. The other area that we see this divergence, this K element, is in the labor markets, right? So this is showing the monthly labor numbers over the last 4+ years. And what you're seeing is back in 22, we're adding almost 300,000 jobs per month. Now, that's really down to almost nothing. Matter of fact, in February, there was a negative 92,000 jobs that were removed. Part of that is an aberration with Kaiser Permanente and short-term job removal. But in general, you're not seeing a lot of strength. So we're in this environment of what's called slow fire, slow hire. So companies really are not firing folks too much to the extent that they went through 21 and 22 where they really struggled to actually hire people. And so they're keeping people, but they're not hiring as much. But again, this is a situation where you see this headline, but the underlying element is it's impacting a particular group more so than others. So this graph shows the unemployment rate over the last 35 years. That's the darker line. And then the gold line is the unemployment rate for recent college graduates. And what I've highlighted there in the red circle is it's just the last few years where recent college graduates have a higher unemployment rate than the general population, right? That's 35 years that has not happened. That's what's going on now. Now, there's a number of reasons for that, one of which is AI. But this is very problematic. And what this is driving, as you think about it, those older workers have higher salaries. They have the homes. They have the stocks. Those younger workers are struggling to get jobs. They're paying more for health care. They're paying more for rent. Oh, and by the way, many of them have sizable amounts of student debt. So again, we talk about this K economy. You're seeing this divergence that's going on there. And then finally, when we talk about companies, the small companies are really struggling. This is the red line, and this is hiring. The small companies are actually shedding jobs over the last year or so, right? Where the larger companies, the yellow and the blue line, they continue to hire. What's going on there? It's a little bit more complicated. There's an element of credit, right? So larger companies can access credit more easily. The other element are the tariffs. We see this with some of our clients who are small business owners. They are trying to struggle with these tariffs and find other supply chain avenues. Where the larger companies, they have global supply chains, they can switch this up a lot quicker. So that's another element what we see. But again, there's two different paths there. So the question becomes, where are we going with this? We're constantly looking at this data. It does help us as we make portfolio decisions. And are we going to see a convergence with this data? And hopefully on the strength side, or is it convert and be on the weakness side? But again, this is something that we're looking at constantly. I'm going to hand it off to Paolo, and he's going to talk about your portfolios.
Thanks, Marty. So let's talk about some portfolio positioning in these very calm and boring markets. Despite the recent headlines, we still remain 100% convicted in the fact that this year is a story about CapEx. And this isn't a start of the story about CapEx, this is a continuation. We actually started this capital expenditures back in last year, 2025, where we had the top five hyperscalers spending over $402 billion. And we could see that right here on the right with Amazon, Google, Facebook, Microsoft, and Oracle. And we see this number actually skyrocket in 2026, where it's actually now over $670 billion in capital expenditure. That's real money being put into data centers and the AI build out within the United States. And so when we think about how exactly we want to tail that trade, because that is a tremendous tailwind for the economy, we knew we really wanted to maximize on the AI trade. So when we thought about the AI trade, there's essentially two schools of camp. There's the hardware side of the equation, and there's the software side of the equation. So on the hardware side of the equation, that's the semiconductors. Those are the companies that build all the chips that power AI. And we could see the list there within SMH, which is the ticker that we use. We have NVIDIA, Taiwan Semiconductors, Broadcom, Micron, and ASML. And the reason why we wanted to make sure that we had direct exposure to chips within the space is because when we looked at that number of capital expenditures last year and so far this year, the only way to build these data centers is to power them through chips. So we knew that the demand was there. We saw the profitability grow within these companies, and we saw real-time revenues. And that's exactly what we're seeing here is the divergence. We see we see the semiconductor trade that we have up almost 13% so far this year, where software is actually down 22.82%. That's a spread differential of 35%. That is real returns within your portfolio. Now, the other side of the equation when we looked at the AI trade was, okay, there's $650 billion being pumped into data centers. How are we going to power them? And that's exactly what we're looking at this chart to the left. This is a 10-year global power demand for data centers specifically. And you don't need to look at every single country there. You could just see the upward trend here. We have a massive energy need, not only here within the United States, but globally. And so when we looked at this side of the equation, we said, okay, what is something that fits the energy that is being demanded not only here, but globally? And that's exactly where nuclear fit into this equation. Now, nuclear from the 70s, 80s, and 90s is not the nuclear that we have today. We have much higher efficiency within the space. It is cleaner. The ability to build it is quicker. And we're seeing that perform in real time, and that's exactly what we're seeing on the chart to the right. We're looking at the position that we use for nuclear NLR against the S&P 500. NLR year to date is up 19.38%, where the S&P 500 is only up 60 basis points. Again, that's real outperformance within your portfolios. Now, I'm really painting a picture here of all sunshine and rainbows, of all the growth that we have in the portfolio. But the fact of the matter is, we were always convicted at the start of this year that we're going to see challenges along the way. Now, Steve talks about the crystal ball. We didn't have the crystal ball that says we're going to have geopolitical events that happened in Iran within March. That wasn't the case. We just knew that we're at all-time highs, and with all-time highs comes volatility. So that's where we wanted to make sure that we stayed rooted within the defensive positions that we had in the portfolio going all the way back to 2022. And we wanted to make sure we continued to be overweight in the characteristics that we think are the most important during some uncertain times within the markets. And that's profitability, dividend growth, and quality. And that's the three positions that we're seeing right here. So the chart to the left, we're looking at 2022. And the reason why I bring up 2022, I hope you all forgot about it. My job as portfolio manager, not to forget about that. But it was a challenging year within markets. The S&P 500 was down just about 20%. And what we're looking here is at our three defensive position, SCHD outperformed the S&P 500 by about 13%. DGRW outperformed by a little over 11%. And DUHP outperformed by just shy of 8%. We knew that these defensive positions hold up during uncertain times, and that's exactly what we're seeing play out in real time now as well. So if we look to the chart to the right, we're looking at these three defensive positions compared to the S&P 500, and we see SCHD up almost 16%, DGRW up over 4%, and DUHP up over 3%. These defensive positions are a nice balance within the portfolio that allow the growthier sides, like our AI trade, like our energy trade, like the Qs, that are going to be your best performers year over year. But also, these three positions are going to create the foundation and the stability within the portfolios that are much needed during times of uncertainty. So in the next part of the presentation, I'm going to pass it off to Ryan.
All right, thank you, Paulo. So I'm going to try to take a lot of what Marty talked about with the economy, a lot of what Paulo's talking about with the markets, and tie it together with this overarching theme of AI that we've seen, for the past 2 or 3 years. So let's start with jobs in the labor market. And as we just saw last week, right, February wasn't a great month for the job market. We lost 90,000 jobs. 2025 wasn't great either. We only averaged about 15,000 jobs being created month over month, which is quite low in a growing economy. And so what we want to look at here is a lot of the, what we've been hearing of how AI is displacing the workforce or labor force has really been anecdotal. And Harvard Business Review just came out recently with a study going back about 7 years, just looking at jobs being posted that can be enhanced through the use of AI versus jobs that can be automated through the use of AI. And so you can see in blue, those are jobs being enhanced. In purple, jobs that are automated through AI. And before ChatGPT came out at the end of 2022, you can see there wasn't really any rhyme or reason to what was happening there, kind of back and forth between both types of jobs. But the job postings, since the end of 2022, beginning of 2023, has really diverged, right? We're seeing a lot more jobs being posted in areas that can be enhanced through AI. Those are technical jobs, analytical jobs, creative jobs. That all, the common denominator is a lot of human interaction in those jobs. On the other side, right, automation, maybe more technology type jobs. Software industry, coding, we've seen a big displacement there. And so the last few years, we've really seen that divergence. We're seeing studies really prove that AI is disrupting the labor force. But I would say even a positive through there, even though it's still negative in terms of how it's growing, automation is recovering a little bit. And I do think we'll continue to see new areas and opportunities for job growth as AI is rooted in our economy. And how does this tie into what we're seeing in the overall economy? And what we're seeing right now is this sort of jobless boom. And if you go back over the last 40 years or so, growth in jobs, which is in white here, so non-farm payrolls, compared to the U.S. GDP in orange, they've been highly correlated. When those are both growing, they're growing together. When they're coming down, they're usually coming down together. But over the last 2 or 3 years, again, we're seeing a divergence here, and something we've really never seen before. As the economy continues to grow, we're seeing a slowdown in the amount of hiring and jobs being shown in the U.S. And so what does that come down to? Well, a lot of it has to do with productivity and what we're seeing right now through the use of AI. Productivity is really growing, and we're seeing it not only in the economy, but we're seeing it in the markets as well. So this is a chart on the S&P 500 companies, and it's just showing profit margins. And you can see over the last 23, 24 years, right, we've had a steady growth in it. When we had COVID, it came down, it rose sharply, came down again, and kind of recovered in 2022 or so. But the last few years, we're seeing record growth in profit margins for these companies. We're seeing, as just a total cost for a lot of these companies, record low numbers in terms of the labor costs that are going into it. So we're seeing a real bottom line impact as these companies are doing more with less right now. And so one of the biggest questions or concerns or headlines that we do see around the markets, what's going on with AI is the market overvalued, and can this continue? And so we wanted to look at just a history of how the S&P has been trading versus the profits for these S&P 500 companies. And so in red, you can see the S&P 500, how it's trading, the price of the S&P, versus corporate profits in blue. And in the top right-hand side of that chart, you're seeing, those are really moving in lockstep over the last few years. The price of the S&P and price of these companies has not gotten away from where the earnings are. They're really moving together. If you go back to the left-hand side of this chart, you can see in the 90s, we started to see a real separation as the S&P continued to go up. Even, well before, years before the bubble burst in 2000, you started seeing corporate profits start to retract. They were actually going down as the S&P started trading up. So we're seeing a real difference in today's environment than what we saw in the 90s into the early 2000s when it comes to just how the overall market is trading. And so where are we kind of in this business cycle right now, or in this market cycle of this AI technology revolution? And so this chart, want to focus really just on the top half of this chart, is showing the tech investment as a percent of overall US GDP. And as you can see in the top right-hand line, we're not far off of what the trend line has been, going back to 1980. We are seeing an increase, right? Paulo showed you how much is going into CapEx, how much these hyperscalers are investing into the future. But it's not at a level that we haven't really seen over the last 15, 20 years. It's far from what we see, kind of in the middle of that chart when you look at the late 90s, early 2000s. That technology infrastructure spend was way more than what the trend was, and a lot more than what we're seeing today. So we believe that, given everything that's going on between valuations, how much is being spent, the investment into this technology, we're still early in the game. What's good is you are seeing the market reward winners and losers. Paulo talked about software versus hardware. You're seeing it with individual companies where some are doing better than others, certain subsectors, certain industries. So we're seeing the market reward, positive investment in these areas. We're also starting to see a little bit of a rotation in the market. And again, that's healthy for a strong, sustainable bull market. I think as time goes on, obviously we'll see some volatility. Volatility can be on the upside and on the downside, and we can continue to see that. And lastly, I think what we should all be excited for is what comes out of this, right? There's going to be an emergence of new companies, new technologies, new opportunities to invest, to grow, and to see this thing moving forward. So I think that's, in a nutshell, what we're looking at, how we view the markets, and how we're tying in this theme of AI with both what we're seeing in the economy and in the markets today. So with that, I'm going to turn it over to Harmony Wagner to talk a little bit about advanced planning.
Thanks, Ryan. So we've covered the markets, the economy, AI. Let's talk about some things that we can control. Let's talk about financial planning. And in 5 minutes or less, I'm going to try to cover 2 somewhat complex advanced planning strategies that we're putting into place for many of our clients. But before I do that, I just want to speak for a moment about what financial planning means to our firm. I think a lot of clients and just a lot of people, when they hear that term, think about answering this question, do I have enough money? And rightfully so. Running out of money, especially in later years of retirement, is a primary financial fear for a lot of people. And so our financial planning process absolutely addresses that and explores, what retirement and all that might look like. But it doesn't stop there. For us, financial planning is not just about maximizing the dollar value you see when you log into your portal and go on that dashboard. It's about maximizing the impact of each dollar to you. For some folks, that's optimizing tax savings so that you get to spend more of your money or your heirs do. For some folks, it's planning for a successful wealth transfer to the next generations. And for many clients, and many of you can relate to this, we sit across the table and we say, it's time to start spending some money. What do you want to do? What would bring joy and utility to your life out of the wealth that you've saved? So financial planning is so important to us in that regard, and very valuable, way for us to add value to the lives of our clients. But now I'll get into some of the strategies. I'm going to start with direct indexing. So it's something we've rolled out over the last couple of years, and you've probably all heard of ETFs, exchange-traded funds, because our portfolios are made up primarily of ETFs. And you've probably also heard the analogy that an ETF is like a basket of stocks, same with the mutual fund. Now, when it comes to ETFs, they are more tax efficient than mutual funds, so they have that going for them. But by using direct indexing, we can increase that tax efficiency one step further. Direct indexing allows us to unbundle ETFs and to hold the underlying holdings instead of the fund. Now, from a tax perspective, an ETF is kind of like a locked basket, right? You could have some positions that are in there that are at a loss, but you can't access that for your own personal tax situation. Direct indexing allows us to do that. So when we have the underlying stocks, and in any given year, the S&P 500, is about 75% of the time. Within the S&P, 35% of stocks are down. So even when the index is up, and if you just hold an ETF that tracks the S&P or something similar, you're probably seeing positive performance for the year. But there's 35% of those underlying stocks that are down that offers a tax opportunity for you. With a direct indexing, we can look at this, very simple example. You see 4 blocks there. 3 of them are up. The overall account may be up, but there's one that's at a loss, one underperforming with a $5,000 loss here. We can sell that, replace it with something similar. So, if it's Coke that's down, we can put Pepsi in the portfolio, so we're maintaining the investment performance that we're looking for in those model portfolios. But now we've created this tax loss that you can use to offset current gains or carry forward. So as a firm that's very focused on tax planning and being conscious about taxes for our clients, it's a really exciting way for us to overlay the investment side and the tax piece to create tax losses that you can use to offset those gains. Because this strategy is involved with capital losses, it works the best in a brokerage account or a trust. But maybe you're sitting here and saying, well, my portfolio is more, pre-tax dollars. I have a sizable IRA. What kind of planning can I do around that? We look at what we call the retirement gap years, especially for clients who have significant IRA balances. As wonderful as that is, and you got a tax deduction for every dollar you put in there, it's been growing tax deferred, it does have some things that you may have to think about as you get later into your retirement when it comes to required minimum distributions and passing it on to your heirs down the road. So we take a proactive approach and we look at these gap years. They typically start when someone retires from full-time work, and they typically end around the time you reach RMD age, which is, depending on your birth year, either age 73 or 75. Within that time, you may find that you have a period of time where your taxable income is the lowest it may be for the rest of your life. If you're not working anymore, but not forced to take out a certain percentage of your IRA, you may have this low tax window that can offer a lot of potential. Some folks would say, great, I'm not paying much taxes, I'm just gonna enjoy these low income years as long as I have them. But we take a more proactive approach and say, how can we utilize this? How can we fill up the lower tax brackets as much as possible using maybe Roth conversions, where you pay tax on an IRA, a percentage of your IRA, and move it over to a Roth so that now all future growth and distributions are going to be tax-free. It could be doing charitable distributions or just proactively drawing down your IRA even before you're forced to. There's many ways that we can use these gap years to be really strategic and optimize the after-tax value of your wealth for yourself and your heirs down the road. I know I've just covered two somewhat complex topics in a short period of time, so if you're finding that you have more questions than answers about this, or maybe there's another financial strategy that you've heard about or read about that you want to explore, this is your sign to please give us a call. We really love having these conversations with our clients. We see it as an important way for us to add value beyond the great work of our investment team. So if that's you, please reach out to us. I will say the best financial plan is one that's bespoke. It's custom to you. And it's going to pull in all the elements of your unique situation, your family, the things that you worry about, your priorities, your tax situation, type of accounts you have. Right? There's so many things that go into what strategy may or may not be right for you. So please have that conversation with us. We welcome that. Without further ado, I'll turn it over to John for Q&A.
Well, thank you, Harmony. How about another round of applause for all the presenters? It was just a great job. So I've got a number of questions submitted. You can keep submitting them. We're probably not going to have time to get to them all unless you want to stay till 11. We could do that. But I would say if you do submit a question that we don't get to, please don't hesitate to grab one of my colleagues after the presentation or reach out to your advisor. So one of the first questions here is, given the current conflict in Iran and the Middle East, investors are understandably concerned about potential market volatility. How does the firm view the war in Iran and its impact on the economy and markets? Marty, I think I invite you to answer this one.
Sure, thank you. So whenever we have something like this occur, what we want to do is look and see what happens from a historical perspective. So in past times when there's a conflict or a war, and what we see is that quite often after it occurs, there's volatility. The market could be down 5 or 10%. There's just a lot of uncertainty, and the market tends to overreact on the downside or the upside. But what happens is then the market starts to assess everything, and usually within the first 30 days, it's recovered most of that. As we talk about, what the market's always really looking at is how is this going to impact the economy and corporate profits and corporate cash flows? And if it assesses and say, hey, broadly speaking, this shouldn't have a negative impact, the market will recover. Now, this time is a little bit unique because of where it's occurring. Many of these areas are big oil producers. The Strait of Hormuz, about 20% of the oil in the world goes through that strait. And as of recently, last couple of days, there's really been no ships going through, and a couple that tried to go through were attacked. So the question really becomes, how long is this going to go on? And that's an unknown element. What I would say is, certainly President Trump is going to be making these decisions. And, there's no president that wants to sit back and watch inflation go up. We've seen oil prices go up to $120. Now they're back down around the $90 range. We've seen gasoline prices go up quite dramatically. And, in the short term, that's not a problem. But if that becomes more long-term in nature, it becomes more problematic. So we saw this last year with the tariffs, right? The market really reacted. It was down 20+% when there was a discussion on tariffs. And he changed course fairly quickly on some of these. And even we've heard this in this discussion with the war, a week or so ago when it started, there was going to be potentially no end to it. We'd be going on for as long as we needed. Just as recently as Monday, he talked about maybe we're getting closer to the end than not. So, our expectation in general is they'd be trying to negotiate an end to it. The big element with this is that, going through something like this, we live in a world of global risk. Powell talked about that. When they started at the beginning of the year, he didn't know what it was going to be. I couldn't tell you what it was going to be either. But things will always occur, and that's just the world we live in. So trying to time this from a one-time off, that is a losing proposition. It goes to what Steve was talking about with COVID. That's a good way to lose a lot of money. But this could be a situation where, hey, you know what? I'm getting close to retirement. Maybe I want to assess what my overall asset allocation is. Well, that's a smart discussion, and we can have that with you. But that's the mindset you want to have. It's more long-term in nature. What is the right allocation versus, oh, I'm going to freak out because I see the headlines from the news, which is emotional. It is emotional, but not reacting to that from a portfolio perspective.
Great. Thanks, Marty. So a couple questions in here around cryptocurrency. So, Paulo, I'm going to ask you to handle this. Combining the two, what's the firm's outlook on Bitcoin and other cryptocurrencies as we move forward in 2026?
That's a great question. We are certainly optimistic and bullish on cryptocurrency, but specifically Bitcoin in 2026. When we made a small tactical trade within the position in Q4 of last year, November 21st to be specific, what really went behind it was what we were seeing from a widespread adoption standpoint and also from a regulatory standpoint. So, well, first, we saw custodians like Vanguard and Bank of America that have been traditionally so conservative not only allow for the custody of these assets, but allowing their advisors to trade these assets for their clients. We saw this as a window. Then we looked at the regulatory landscape and we saw, the Genius Act passed in 2025, which brought a lot of validity to stablecoins and a lot of dry capacity that came into the crypto markets that also piqued our attention. And seeing how the Clarity Act is still going through the Senate floor right now, again, just brings more legitimacy within the space. Volatility within the space is absolutely known. There's no question about it. But a lot of times we feel questions that when we see these bouts of volatility, this time, cryptocurrency or Bitcoin, it's going to zero. It doesn't make sense. And I always like to remind everybody, we've been here 6 times before when we've seen Bitcoin sell off by more than 30%. And not only do we recover all 6 times when we saw that decline of 30%, but the average return from a 1-year outlook from that point is 270%. So when we see volatility like this, it's not something that wavers the amount of conviction we have in the space. It's more, where are we seeing more opportunities and how do we want to make sure that we're maximizing on that?
Tough question, good answer. We got a financial planning related question. What are the biggest challenges you see with transferring wealth to the next generation? Harmony, I think this one's good for you.
Yeah, a lot of our clients have that as a goal, right? If you have children, grandchildren, loved ones, you want to make sure that what you have is going to them in the most efficient way. And the statistics on that are a little bit scary. When you look at it for wealth transfer, 90% of the time, wealth does not successfully move past the 3rd generation. So it's not something that happens by accident. It takes a lot of thought and proactive planning. The earlier you can address it, the better. And the 2 challenges that I really see, number 1 is just a lack of thought about tax treatment. So for those of you who don't know, the different types of assets you might have are treated differently for tax purposes during an inheritance event. You think about pre-tax dollars, a taxable account, maybe property, Roth IRA, annuity, all these different things that they don't have the same treatment. And so when you think about what type of accounts you have and what type of people you want to leave money to, whether it's charities, perhaps children that are adults in their higher earning years of life, you could have some grandchildren maybe starting out, lower tax bracket. You really want to take all that into account. It doesn't mean you're going to make widespread changes, but having some thought put behind that to make sure the way it's all moving is as efficient as possible can really go a long way towards having less of your estate eaten up by taxes unnecessarily. The other thing I would say, and we encourage our clients to do this, is to let us engage with your children as early as possible, right? Even if they're just starting out of college, we love the chance to have a quick phone call with them, make sure they're doing the right things for themselves financially, and make sure that they are connected to an advisor so that someday down the road, hopefully far down the road, when they inherit that wealth, it's not their first time thinking about it. It's not their first time hearing how you manage it prudently. It's not their first time talking to an advisor and getting a feel for what that's like. So those 2 things, thinking about taxes and introducing your loved ones to your advisor early on, can really go a long way for that successful wealth transfer.
Here's a question about concentrated stock. With the bull market of the past 15 years, many of us have large concentrated stock positions. What is the guidance you can provide on how to handle these positions? Ryan, I know you've had a lot of exposure with this.
Yeah, I'll touch upon this. There's different ways to go about it, and it really, I think it comes down to what that concentration looks like, what you want to accomplish moving forward with that concentration, and maybe a little bit of what your time horizon is. We started implementing recently this idea of 351 exchange funds, and it's a great concept in terms of looking at it may be a concentrated individual position, but you can also use maybe highly appreciated ETFs. In the case that I was working on, we had a situation where we had both a combination of individual stock positions, but also an overweighting in an area of the market through just the growth of ETFs for the last 10 or 15 years. And what we were able to do is transfer both the individual securities and ETFs into a new ETF through the use of a 351 exchange fund. It's a little bit newer in the ETF world, uses some old tax codes to create this, but it is kind of a one-time planning option. And that's one way that we were able to, and the goal of this was really not so much of one individual holding that was way overweight in the portfolio. It was really just an exposure to a concentration piece of the market. And so we wanted to diversify that risk, get to a little bit more of a new market neutral positioning in the portfolio without taking on any capital gains in the interim. So it was a really great planning strategy, and we have those available as we move forward if that's something in your case. There's exchange funds, which we've been able to utilize. That may be more beneficial with one individual holding that just becomes 15, 20% of your portfolio, and you want to diversify. But there's a lot of options out there, and there's a lot of ways that we can help mitigate tax exposure and mitigate your portfolio risk, especially, again, if you are getting a little bit nervous or fearful with where the market is today. I know we talked about, I think it's still early stages of what we're seeing, but again, we are seeing higher valuations, and there's always that geopolitical or uncertainty out there. So if those are things that may be of interest or you have on your radar, please let us know. I think we have a lot of good options for it.
Here is a question, could be related to college savings, but what does the firm recommend using the new Trump accounts to fund for children or grandchildren?
Yeah, so the new Trump accounts that are open allow you to save, tax-deferred dollars on behalf of a child. I think one of the most strategic ways we see using it is potentially doing Roth conversions once they get to 18, once they have earned income. So that can be a great way. They are still relatively new, so we're still learning a lot about them. But they're also for children born in certain years. There's also a seed money that can go into it as well. So there's some exciting kind of strategy options, especially with that Roth conversion. You think about the power of compounding in a tax-free account for a young person, and having that fund to grow their tax deferred, and then the option to convert is really exciting. So if you want to explore that more, please reach out to us, and we can explain more details.
And a few of our colleagues, Vinny and our newest associate, Audrey, we're working on some nice spreadsheets to kind of lay this out, and so you can kind of hold something tangible to see what maybe some of the advantages or what that may look like in 18, 20 years down the road. In those cases. So if that's something you have questions on, I think we have some good resources for it.
Just one other thought, though. As you're looking at this, and this is where working with us on this, I would still recommend, if you're going to start putting seed money in there for kids or grandchildren, using the 529 plans first. One, if you're like, okay, I'm pretty certain my the child's going to go to college. Now you're up to a $10,000 New York State tax deduction per couple. That money's going to grow tax-free if you take it out for qualified educational expenses. And a big element of this, too, is that you can now convert up to $7,500 a year into a Roth for that individual if they don't use those dollars, up to $35,000. And they have to have that money in there for 15 years. The other element to appreciate, I think these Trump accounts are great to the extent you want to do a Roth conversion, but you have to appreciate when you do that Roth conversion, there's going to be a tax consequence on the gains, right? So if you start putting in when they're 2 and it continues to grow, whatever is a gain in there is going to be taxed as ordinary income. Now, it's still a great idea. It can increase the amount that they have in a Roth, but when you do the 529 plan and you convert those to a Roth, there's no tax consequence. That full $7,500 per year goes right into the Roth. So again, my suggestion is you first really think about the 529 plan, how you want to maximize that, then use the Roths in addition to that. And as Harmony mentioned, if you have someone who's born right now in the next couple of years, you should definitely open one because you get $1,000 that the government will put in there. And there's even some wealthy individuals that are putting another $1,000 or $2,000 in there. So you got to kind of think about it in those terms.
Here's another portfolio-related question. Has the firm considered expanding their international exposure?
So being out of international within our portfolios for the better part of the last 15 years has certainly been a main driver of our performance. But, you know, never is never, and Steve knows the stats much better than I do when we talk about the different indices and how much better the performance has been out of the S&P 500 and the NASDAQ compared to not only developed but also emerging markets. The thing that we've been really focused on this year is, and I hope I made this very apparent when I talked about the AI trade and specifically how we want exposure within the AI trade, being within semiconductors, right, the chips. And what we're seeing right now within the chip trade is actually a bottleneck within memory. So when you build these chips, you need memory that actually supports the compute that comes out of it. And right now, within the world, there's just not enough memory that's being produced. We have some exposure right now within SMH, our holding, with Micron, local company. But there's also some very attractive international companies that can fit this mold. So we look at South Korea with SK Hynix and Samsung, what they're doing there. That actually might be an opportunity. And given with the recent events of higher oil prices, a lot of these international companies, specifically within the EM markets, they're very, very sensitive to a rise in oil. You know, specifically, I'm talking about South Korea. They import 92% of their oil, with over 90% of that comes from the Middle East. So opportunities are there. It's not in a portfolio now. Historically, that has been an outperformer for us. But again, all eyes are always going to look at opportunities.
Yeah, I just want to piggyback onto that because, you know, over the last year or so, international investments have done better than U.S. investments. But we look over time, and we've been out of international investments for quite some time. We've been underweight forever, international investments. And if you look over the last 15 years, and I'd like to just point this out, the average return in the S&P 500 index was 14% approximately, year in, year out. With all the headlines, with all that's gone on in and around the world, 14% if you were invested in the S&P 500 index. That's pretty darn good. NASDAQ, and I only bring NASDAQ up because it's one of our core positions. You have as much S&P in the portfolio as you do NASDAQ. Your average return year in, year out, 19% a year. That's even better than the 14%. And that's our growth section of the portfolio. We really believe in growth, and we have a slant towards that. Now, we also have, not everybody's invested like me. 100% of my money is invested just like yours. The only difference is I'm all in stock. I have no problem being in an all-equity portfolio. When the market goes down, if anything, I look for some cash that may be hanging around the house, under the mattress, in the cookie jar, because I want to put it back to work. But bonds we have in a lot of our portfolios, because a lot of clients don't want that volatility. I won't use the word risk, because there's risk in every asset class. There's risk in stocks, bonds, commodities, real estate, cash. There's risk in every asset class. You need to understand the risk, and hopefully we do a good job educating our clients on that. But with bonds, there's less volatility, not as many ups and downs. Your average return over the last 15 years has been 2.54%. A whole lot less than stocks, but you sleep better at night because you feel like there's not as much up and down, not as much volatility. And then gold, which has been getting a lot of publicity, obviously, lately. We haven't owned gold since 2011. When gold hit just about $2,000 an ounce back then, we sold out of gold. Gold went down to $1,100. We know that it's hung around there, $1,500, $1,600 forever. Now, as we sit here, it's over $5,000 an ounce. So what was your average return in gold over the last 15 years? About 6%. So the S&P and the NASDAQ by far have outperformed that. And I'm not here to push stock over any other asset class. I just want to share with you why we believe in diversification. And as Marty says, what portfolio is right for you? If you wanted to get more aggressive, the time to do that is when things look bad. If you want to be more conservative, the time to do that is when we're at new all-time highs. So let's go to international investments. Your average return in developed international countries over the last 15 years has been somewhere around 6-7%. a whole lot less than the U.S. stock market. Our U.S. portfolio has by far outperformed the stock market, and we're proud of that. Emerging markets is about 4%. So over time, we've done our clients a good job by not being invested overseas. And I'm not going to say we'll never be invested. The investment team right now is really making a good case for the reasons that Paulo just pointed out of why maybe we should be looking at some emerging markets with a big focus in those countries that are in the AI area. And you may see that. But there you have it. That's for the biggest reason why we haven't been in international investments. And in hindsight, everything's crystal clear. And one of my favorite sayings, in hindsight, it was really brilliant that we haven't been invested there.
Yep, I think we have time for one more question. And as I said, if you do have questions after this, you can reach one of the colleagues or just reach out to your advisor. We certainly want to answer anything you have. And I'm going to let any one of you answer this one. It's kind of a general question. What do you think about the theory that if everyone is buying ETFs, no one is paying attention to the strength of the actual companies?
Yeah, I mean, I think when we hold on to a basket of stocks like an ETF, the whole thought process here is the diversification in a specific area. So where conviction lies is looking in either a certain sector or industry, and that is really going to power where we want to be invested. And actually, the real benefit there is not having to worry about each and every earnings report out of, say, 300, 500, 1,000 companies that make up that ETF. So that is the power within diversification, is knowing that in any given quarter, when we have those earning reports come up, we're not living and dying on that earnings report. It's important. So really where you want to have your conviction is where you want to be invested within the markets, what sector it is, where it is globally. I think once you have that type of conviction, that's where real diversification comes, and that's what the benefit is of not having to worry about each and every company's individual strength.
I think the thing to remember too is, although there's so much more money that's going in ETFs in the tens of trillions of dollars, so the growth has been tremendous over the last 30 plus years, there's still trillions of dollars that is actively managed out there, right? So that means you have a manager where it's a separate managed account, a mutual fund, a hedge fund. They're going out and buying these individual companies. And one of the reasons we like ETFs is when you start looking at it, that ETF more often than not outperforms most managers, right? And that's true with most asset classes. So you're paying a low cost, and you get complete transparency, and oh, by the way, you outperform most active managers that you're going to pay more money. So again, I do think there's much more money going into passive investments, but that doesn't mean there's still not a lot of money that's trying to find opportunities to invest in, and it's price discovery, right? That's what they're doing, is price discovery. So some of these managers will be successful. I would tell you, Paulo as a portfolio manager, if they said, hey, boy, I think this portfolio manager seems to be outperforming, we could potentially go ahead and get invested with them. But just consistently, those managers struggle to outperform that index, year after year after year, right? They might do it for a year or two, but not time after time.
Steve, would you like to make any final remarks?
I mean, what the hell? He's got me all set up with a succession plan, I got food tasters. I get worried so much. There was a day when I didn't have to worry so much about that. But no, in all seriousness, being surrounded by the team that I am, I think tonight you see the expertise. And, to continue on with what Marty said, for 33 years as a fiduciary, we have been using exchange-traded funds on behalf of our clients ever since then, for the reasons that Marty said, but mostly because 65 to 85% of the time we have all these statistics, as Marty alluded to, the active management. When you have a stockbroker at a Merrill Lynch or Wells Fargo or whatever buying and selling stocks, or you have a mutual fund where the money manager is buying and selling stocks, 65 to 85% of the time, they cannot outperform their respective benchmark. That's why we've been having the portfolio structured like they are. We only have 2 individual stocks in the portfolio, Apple and Amazon. We like those companies. All our other dollars that we manage are managed in ETFs for that reason. In all seriousness about being pushed out the door, you know, I'm still alive and well, and as I shared with you earlier, I'm feeling pretty darn good. But doing this for 40 years doesn't mean I can't learn a thing or two. We've made some trades in the portfolio recently, really some trades that we feel really good about. Recently, our advisors have really, you know, looked at each and every client because we made some trades in the taxable portfolios, and there were 2 clients, and I called Harmony. I said, Harmony, I said, you know, these people aren't working. You know, they're in a low tax bracket, and they're not 65 yet. I said, we can take gains there. You know, we always tell clients, we hope we give you the biggest tax bill every April. That means we're doing our job. What predominantly the reason why you engage our services is to manage your wealth and make money for you. We do a whole lot of other beautiful things for you, but predominantly you want us to make money for you. You want to trust that we're doing that job. So it's okay to not have the tail wag the dog. You always want the dog wagging the tail. It's okay to have taxable gains. But I learned a thing or two, you know, after 40 years. Harmony says, Steve, and then she laid it out for me. She says, these 2 clients, yes, they're not 65, and yes, they're really, you know, they're hardly making any money, but they're on Medicaid. And if we take gains, that is going to, we know what, Marty showed you the slide of healthcare. You know what healthcare costs nowadays. And I mean, what can I say? Hats off to Harmony for teaching me a thing or two. And that's what I'm surrounded by, just all this expertise that you can trust, expertise that you can feel comfortable with. So you're in good hands. The other thing that I get worried about, you know, for 12 years we've been doing this. Ryan and Marty kind of started this state of the economy, and it was a beautiful thing that we started doing for clients. But I've always had some favorite slides. And yesterday morning I'm reviewing the presentations, and I said, come on, where the heck are my favorite slides? You know, talk about worried about being pushed off, you know, to the side. I said, come on, you know I love these slides, but let me verbally go over these slides with you. As I said earlier, no matter what happens, no matter how much on paper the percentages go down, no matter how ugly it is. 4 years ago, Harmony coined this phrase. I've stolen it many times. Every investor feels the world's coming to an end when they lose money. Guess what? The world hasn't come to an end yet, and even now it's not going to come to an end. And that's what you have to remember. You may question, why do you own stocks? I gave you the percentages over the last 15 years. I could go back over the last 25, 50, 75, 100 years. They're pretty much the same. So what you have to remember, when there's volatility, when there's blood in the streets, we actually get a little giddy about that, because that gives us an opportunity of taking advantage of buying into some areas that may have been more expensive before then. So volatility is an investor's friend. And having us manage that portfolio and doing those things for you is important. Another slide that I used to use, the average since 1980, 46 years, the average up and down, high to low, peak to trough in the stock market, the stock market swings 14% a year on average. 14% swing every year for 46 years. So when there's volatility, that comes with being invested. And believe it or not, over the last 11 years, stocks have been down 2 of the 11 years. Guess what? Bonds have been down 2 of the 11 years as well. Stocks are up more than they're down. So 14%, and since all of the last couple weeks we know have been crazy, I think the market's swung less than 5%. So this is why you need to kind of, you know, if it gets you nervous looking at the headlines, don't look at the headlines. I try, you know, for the most part, I watch Bloomberg, but I was watching CNBC this week, and believe it or not, it's 17 years to the day. You remember 2007 to 2009, October to March 9th of 2009? The market was down 50%, 50%. Talk about the world coming to an end. We had a new client from New York City, gave us about $10 million this summer, just before Bear Stearns went out of business, just before Jim Cramer said that Bear Stearns was a great investment. Always asking, when are we getting invested? I said, be patient, be patient, be patient. And February 25th, Sue and I would have celebrated our 25th anniversary, and I wanted to take her somewhere special, but I couldn't leave my clients. You know, the markets were down almost 50% at that point. And I said, Sue, I said, you know, we can't go. We can't. We were going to go to Paris. I said, we can't go. I said, I'm going to take you to Syracuse, babe. We're going to get a couple massages. We're going to get a nice dinner. I'm going to be back, and I'm going to be able to be at my desk on Monday morning. And Angela remembers these days. She's been with me a long time. So March 8th, we used to do the radio show on Sunday nights, 8 o'clock. March 8th. And this week they gave Art Cashin, who passed away, God bless him, on CNBC. They were doing an interview on how he called the market the morning of March 9th. Well, that's good. Stevie B, March 8th, 8 o'clock, WGY. You can go back and look it up. I actually was on the radio and I said, hey, we've been raising cash for months, but we put it all to work. And not only did we put it to work, we bought into some areas that we weren't invested in before, and we actually leveraged part of the portfolio. You would have thought I had a crystal ball. Paulo said we don't have one, and we don't. 13 hours later, the market bottomed. And my justification, and this is how we think, and I'm going to leave this thought with you. The market was down 50%. GE was like $5 a share. Citigroup, $1 a share. Talk about the world coming to an end. How much lower was the market going to go? And I said this, it could go maybe 5%, 10%, I don't know, but I feel there's more upside than downside. 13 hours later was the bottom of the market. You would have thought we had a crystal ball. We didn't. But that's how we think, and that's why you pay us to take the emotion out of the decision-making process so that you know you're in good hands. You know, and not that we're going to get every investment idea right. We won't. And sometimes we get into something and we may get out of it soon after, and that's okay too. We're looking at everything every day, every week. We're looking at everything that we own, but we do a pretty darn good job. So before we hand this back over to John to close out, let's talk about some good news. And I promised my team, I was texting them a little while ago, team, come on up. I promised you I wasn't going to do this to you. But, you know, yesterday we were in a square room, so I didn't have to do it because I could say, hey, this is the rest of our team. Well, today we can't do that because of the way the room's laid out. So come on up. Let everybody see you. Sam just had a baby. So, you know, this is our team. There's everybody but Casey. Ed and Casey are really the portfolio. They do all the research and trading. Casey relocated to Jupiter, Florida, so we have an office in Jupiter, Florida. So he's actually working out of that office. We're entertaining about 40 clients there next weekend. Angela, John, Paulo, Casey, and I are going to be down there. But this is our team, and we have some good news, and I want to leave you with some good news. Lauren, my daughter, where is she? My favorite daughter, getting married in June. This is when she would need Sue the most in her life, so I'm trying to help her out as much as I can, but a dad can only do so much, and she went looking at wedding dresses a few months ago, and I said, Lauren, do you want Dad to go with you? She says, no, Daddy. She says, I don't want you to see my wedding dress till the day of my wedding. So I can't do everything for Lauren, but I'm trying my best. Katie is getting married in June as well. Katie is just... And then we have Scott having his third baby. As I said, Sam just had a baby. She just rejoined us after spending some time with her little baby. And we have Shelly, who's going to have a baby in May as well. Now, let me tell you, for those of you wondering how long the firm's going to be around for, look at this. The firm's going to be around for a long time. Thank you for being here. Thank you for taking time out. I can't thank you enough for placing your trust in us. I'm going to hand it back to John to end things. Please call us over the week if you have any unanswered questions. Be careful going home. And I can't begin to tell you how much you all mean to me. You really do. So thank you.
Thank you, Steve. Well, we appreciate everybody attending tonight. We hope you enjoyed the food, the cocktails, and obviously the presentations. And I would say if anything that we presented tonight sparked any thoughts, reach out to your advisor. We want to hear from you. So again, thank you for coming. Again, we're very grateful for the trust you put in our firm, and we really appreciate it. So thank you. Have a great night.